Greg, welcome to the BloomLiving podcast. Happy to have you.
Thank you. Happy to be here.
Here's some of the things I was actually going to touch in off the top. And so why don't we just, kind of start talking about them. As a business owner, I'd like to do a lot of reading. I don't know about yourself, but I like to do a lot of reading. So right
Absolutely.
now I'm reading a book called Profit First. I'm currently reading The Creature from Jekyll Island at the same time. I'm reading another book at the same time called Power Up Your Life, The 12 Powers as well, and a couple other things and those I need to do for some of the courses I'm in. What sort of stuff have you been reading lately? What kind of books have you gotten into that inspire you and also keep you in the loop on what's going on in the financial biz?
Actually, a really interesting book called Common Sense Investing. I don't know if you've ever read that, but talking about the principles of not timing the market and just actually maintaining, quality, low costs and funds and looking at it over a long period of time and seeing how the market performs over the period of time, right? So there's going to be volatility. There's going to be hiccups. There's going to be maybe a potential recession, right? Nearing soon. We don't know, but we're definitely due. And, having a more of a long-term strategy and not trying to time the market so much. And for me, I'm very big on that with a lot of my clients. We're not going to be in too many aggressive types of investments, whether they're ETFs, mutual funds, or anything like that. If they have short-term goals where they need real liquidity or cash on hand.
One of the things I heard you say really is patience, right? If you're investing in the market, patience. And I'm a Warren Buffett fan, and I truly believe you make your money when you buy, right? You don't make your money when you sell. You make your money when you buy. So it's buying at the right price. It's buying a great business and getting it at the right price, and then being patient to allow that company to do what they're out to do.
Right.
And staying with it. One of the struggles I have as an advisor, and maybe this is the same for you, is that if clients need access to money and we're invested in the markets and that's our only access to funding, right? Now we have to sell, and we may be selling at the worst possible time, right? Like if you look at 2008, 2009, if people needed access to their money, they were selling at rock bottom low prices.
Right.
So you're getting the worst price for a great asset, perhaps.
Right.
And then you and I are both in the insurance business as well. I'm an advocate of bank on yourself.
As am I.
So I think you are. And one of the reasons I love it is because in a liquidity crisis, I'm not selling anything. I'm actually accessing funds. But maybe just talk about how you frame a properly structured whole life insurance policy for that liquidity moment.
Great question. So you also touch on a couple of things that I think are very interesting, right? So first off, before I get into the market and you had mentioned something, if people needed liquidity at that time, right? Most people, if you didn't sell on the low, if the market's down and you rode and your time horizon's a lot longer, the right move would have been not to sell in a down market and ride it out. But if you're someone who needs liquidity, right, and you're investing in the market, what we do is we use specially designed life insurance as an asset class. So I know that you're very familiar with this concept, right, called banking on yourself or infinite banking. There's different types of descriptions that different professionals or advisors use, and they're all great. They all serve their different purposes, but banking on yourself. So what it is whole life, specifically whole life insurance. For those who don't know what whole life insurance is, it's a form of what we call specially designed life insurance. So in the life insurance realm, there are different types of insurance. You have what we call term insurance, which is something that most would consider an expense. So you buy it, it lasts for a certain period of time. Let's say it's 10, 15, or 20 years or 30 years. And you're really only buying it to protect something in your life. God forbid, if someone who is the breadwinner in the family passed away, what legacy are you leaving? Meaning, do you need to cover your mortgage? Do you need to send your kids to college if you have kids? Do you want to leave your spouse or someone with some money? So that's what term insurance is. It's just protecting something for a certain period of time and you don't get any money back. You have to pass away in order for the estate to get that money.
Right. So it's kind of like catastrophic risk, right?
Right. It's risk management 101. Now, whole life insurance is an asset. So now the second type of insurance is what we call permanent life insurance, which serves as an asset class where you're putting in dollars into an account or into a policy where, God forbid, if you did pass away on day one, you have a death benefit, right? A tax-free benefit that would pass to your beneficiaries, just like term insurance does. But the difference is that you're also putting money into an account that grows interest over time. And the way that whole life grows interest is it's based on the performance of the insurance company that you're actually investing with, or what we call buying the policy from, right? So you're a mutual insurance, or you're a mutual owner. You're a mutual owner if you're buying from a mutual insurance company, where at the end of the year, after the company pays off death claims, they pay off their expenses, or they cover their expenses, and they have any money left over, they pay you back in the form of a dividend. So it's money that's given back to the policy owner. Thank you so much for being a policy owner. The companies did well this year in regards to, we now have money left over, and that we're going to give you back into your policy as you continue to grow with us over time. So it's just like a stock, right? If Apple did well, in the sense of a dividend, it's like a stock. That's what I mean by that, not the volatility factor. So if Apple, let's say, does very well at the end of the year, they have money left over. What do? They can either reinvest. Any big company can reinvest back into the company, or they can take that cash and distribute it in the form of a dividend back to their shareholders. So the distribution to the shareholders from a dividend standpoint is what I'm referring to with whole life. That's how it works. The policy, the company gives you as the policy owner a dividend that grows your cash over time, and it's just an interest-bearing account. You put in X for a certain period of time, and eventually you'll have more in that account than you put in. And there are certain guarantees to different policies as well. So it's what we call it's one of the safest asset classes out there, because insurance companies have been doing this for so long that they are able to provide these types of guarantees for people. That's actually in a written contract.
Right. Like we're talking, and I'll just jump in here, but we're talking like 200 years.
200 years, yeah.
Trading whole life has been around. And one of the beauties is also it grows tax-free.
Yep.
Right. So it grows tax-free. But here's where so I was a financial advisor, as I am today, a financial advisor, totally bent on the stock market, where you buy term, you invest the rest. Never could I ever see the light of day to owning a whole life insurance policy. I read Becoming Your Own Banker, the infinite banking concept in 2013, and my head popped off. And I was like, wait a second. I had no idea you could borrow against your policy. And not only can you borrow it against it, there's no questions asked. They have to lend you the money. It's completely private, so nobody knows you borrowed the money. It doesn't show up on a creditor report at all. It's a private arrangement. You get to set your own terms to paying it back. So when I read that, I was like, mind blown. Okay, I didn't know that. And then I went down the road of, I got to prove this is BS. Right? Like I'm that guy that is like, okay, that's too good to be true. There's got to be holes in this.
Right.
And the only hole I have found in it is two things. One is it's called insurance, right? So immediately people are like, whoa, don't want anything to do with it.
Right.
And the other one is it's kind of slow. It's like paying down a mortgage of a house, right? It's a slow process to where you win in the end. And, in today's world, everybody wants everything right away.
Exactly. You're absolutely right. So that's why when it comes to planning, you have to have what we call your more aggressive bucket, right? Maybe things that can be more volatile. And then you have your safer asset classes. So what we use, whole life insurance would be considered, in my opinion, a bond type of replacement. It's a bond replacement.
But also for business owners, I think this is like a gem to have inside of a corporate structure especially where you have to insure the primaries of any business. And I'll just say this, the other day I was talking to somebody in Texas, and my wife Leslie and I just howled at this. We were talking, I just met the man, and he goes, Thomas, you know, I don't have a great Texas accent, but he's like, Thomas, there's God, family, your community, and whole life insurance.
That's great.
All right, my friend, it's been an absolute pleasure. It's been great connecting with you. This is, you know, we've never talked this long before in our lives ever. So it's been great for me to really get to know who you are and your thinking. And I'm glad we think a lot alike.
Thank you so much for having me on. It's been an absolute pleasure. I appreciate it. To the next time, best of luck with your podcast, and keep it rolling, man. It's great. Keep it rolling. I love it.
Okay. Cheers, man.
See you guys.